and welcome to the Business Standard Morning Show. I'm Nazia Iqbal. Let's take a look at the stories for the day. There seems to be a difference of opinion within the government on the proposed e-commerce rules. The Finance Ministry, the Ministry of Corporate Affairs and Niti Aayog have all raised objections to certain clauses in the draft rules, especially those related to associated entities being listed as sellers on e-commerce platforms and the potential abuse of dominant position by companies. How serious are these differences? Or is it just part and parcel of any strong policy-making process? Let's find out in this report.
A top government official recently told a news agency that there was a significant difference of opinion within the government regarding the draft e-commerce rules proposed by the Consumer Affairs Ministry. The Finance Ministry in particular has raised strong objections. But this isn't just about a difference of opinion between different arms of the government. Instead, it is in line with the trend of sharp disagreements between government departments on the one hand and Sangh Parivar affiliated organizations on the other. But first, let us understand some of the contentious points in the draft e-commerce rules and what the finance and other ministries have to say about the policy. E-commerce companies have raised concerns over a clause that says they will have to ensure none of their associated enterprises is listed as a seller. For example, Tata won't be able to sell Starbucks products on its upcoming super app. Starbucks operates in India through a 50-50 joint venture with Tata Consumer Products. Also, under the fallback liability clause, e-commerce firms will be held liable in case a seller on their platform fails to deliver goods or services due to any negligent conduct that causes loss to the customer. Now the industry fears a change in the e-commerce business model should the draft rules be implemented. Small businesses fear there might be an increase in compliance burden. Also, the rules ban e-commerce flash sales, but there is no clarity on what constitutes a flash sale. The Finance Ministry, the Ministry of Corporate Affairs and Niti Aayog have all raised objections. Niti Aayog Vice Chairman Rajiv Kumar has said that the proposed rules send the message of unpredictability in policy making, and the Finance Ministry has called the rules excessive, adding that these would hit a sector that would boost job creation and tax revenue, and also hamper ease of doing business. The Ministry of Corporate Affairs opposes the clause that says e-commerce firms should not abuse their dominant position in India, calling the provision unnecessary and superfluous. It has said it is undesirable to introduce a mini competition law regime in the rules. Let us go to Business Standard's Nivedita Mukherjee to understand what may have compelled these ministries to express their dissatisfaction with the draft e-commerce rules.
So the opposition to the draft e-commerce policy from so many ministries, including finance, is, I think, a message that this government is not anti-industry. Besides Finance Ministry, Corporate Affairs Ministry and government think tank Niti Aayog have raised red flag against some of the clauses in the draft e-commerce policy. The point that they have made is that clamping down on flash sales by online majors and holding e-marketplace firms accountable for every violation by sellers on such platforms will be counterproductive for businesses. As we have seen, the Tata Group had voiced its concerns over the draft policy, joining companies such as Amazon and Flipkart. And it's difficult to ignore the opinion of a conglomerate like the Tatas, which recently put in a bid to buy Air India. Tatas, of course, are planning a super app, and such policy clauses would make it a difficult business.
However, the Confederation of All India Traders, or CATE, has firmly backed the new rules. Previously, it had criticized the Niti Aayog for interfering in the e-commerce rules proposed by the Consumer Affairs Ministry. CATE had also alleged that since its inception, Niti Aayog had done absolutely nothing to support the 80 million traders of India. In a statement to Business Standard, CATE National General Secretary Praveen also aimed fire at the finance and other ministries for opposing the draft rules. Today, Niti Aayog is pointing fingers at the e-commerce rules, but it did not utter a single word when the laws were being violated by these big e-commerce goons. Was it not the duty of Niti Aayog to ask them to follow the rules strictly? The same is the case with other ministries and departments. Today, they are poking their nose. Why did they keep quiet when these companies were continuously flouting the rules? Said Praveen Khandelwal, National General Secretary of CATE, in a statement to Business Standard. Khandelwal is of course referring to the very serious allegations against Amazon and Flipkart of giving preferential treatment to a few seller entities in which they indirectly held stakes. Importantly, this is not the first time that we've seen such disagreements between the government and other bodies or associations that are not involved in policy making but share the ruling party's ideology.
Actually, this is not the first time that there are divergent views within the system. Finance Minister Nirmala Sitharaman had said recently that it was wrong to call Infosys anti-national. She was referring to a report in Panchajanya, which is a mouthpiece of RSS. The report had attacked Infosys for glitches in the income tax portal, saying the company was funding anti-national forces. Earlier too, there have been similar instances. A task force constituted by the Finance Ministry, for example, had said the Department of Telecom's suggestion on 5G reserve price was a bit too high. On the whole, I think the opposition to the draft e-commerce rules, which were framed by Consumer Affairs Ministry, show that there's room for debate in policy making.
Well, the disagreement may seem unpleasant right now, but who's to say it's wrong or unhealthy if the concerns of all ministries can be addressed and stakeholder suggestions can be incorporated? We'll obviously have a better policy. Earlier this month, reports suggested that because of the pushback, the government was taking a second look at the draft rules. However, in a recent public statement, the Piyush Goyal-led Consumer Affairs Ministry, which has drafted the rules, appeared to be holding its ground. How the final policy might look is anybody's guess right now.
Climate change has thrown up key challenges for power companies, and there is an urgent need for them to limit their coal-based production and increasingly move to non-carbon generation. And as the power sector moves to renewables, there is bound to be some disruption. Business Standard's Jyoti Mukul spoke to Tata Power CEO Praveer Sinha on how his company is addressing the concerns around carbon emissions, what are the challenges being faced, and the need for flexibility in the power market. Watch this exclusive interview.
Welcome, Dr. Sinha. So climate change is one of the issues which is confronting the global community at present, and we have a COP26 coming up in November. From the perspective of a power producer, which also has a substantial coal-based capacity, what do you think are the key issues which need to be tackled both at the government levels as well as at company level?
Now, when we talk about the factors which impact the carbon emissions, the biggest is the heating and cooling that takes place. And this is for all types of businesses, all types of homes, and all types of industries. And there is a huge necessity that how we can bring this down. And nearly, I would say, 50% of the carbon emissions is happening for the heating and cooling purpose, for meeting the heating and cooling purpose requirement. The second area is, of course, power generation, which is about 20% globally, which is used for producing electricity, and about 30% is the mobility, the transportation sector. And there is a need now that all the three who contribute the maximum for carbon emission take corrective action. From power sector perspective, they can play a very, very important role, especially if they move away from carbon-based generation to non-carbon generation, whether it is hydro or it is solar, wind, storage, biomass, biogas. Right now, we are about 30% is non-carbon generation, and we will become 60% by 2025 and 70% by 2030. And we are the only company in the country which said that we will become net zero carbon by 2050. But it may happen much before that because we expect our existing power purchase agreements to get over by 2040 and or 2041. And we expect that the useful life also will not be much more than beyond that. So we are definitely looking at a very, very aggressive target to reduce our carbon emissions. And our target is that we become a net zero company, maybe by 2045. And that's where we are working towards. We will decommission many of our coal-based plants as and when they complete their PPA term or complete their useful life. And we will only make all fresh investment in the non-carbon generation, and that will, of course, be in renewable and areas like storage and hydrogen. I also want to mention to you that when we are talking of renewable penetration, we are also trying to cover a lot the mobility part of it. So all over the country, we are putting up now EV charging facilities, which will support the mobility that will happen. And this is not only in cities, but also intercity travel. We have started a very ambitious program from Kashmir to Kanyakumari, the 3,600 kilometer stretch. We will have EV charging facility right across and at each pit stop between cities, starting from Srinagar onwards. We will have intermediate points where the charging will take place. So I think we will play a very, very critical role going forward in ensuring that we provide clean energy and abundant of clean energy to the consumers in this country.
Isn't it a bit ironical that recently, despite all the push towards the renewable sector, recently there was this whole coal shortage situation because of which non-power users of coal were denied coal, and there was a whole debate around the health of power distribution companies, whether they didn't pay on time and therefore the generators did not stock up coal. So how do you look at this whole situation in India?
Coal stock in the power plants was less. And this is primarily because during monsoon period, many of the coal mines, they get flooded and mining becomes a challenge. And so also the transportation of coal through rail becomes a challenge. This is something which happens every year. This is not something which has happened. Some years the impact is more, some years the impact is less. And also this happens in winter months when we have a lot of fog, especially in northern and eastern part of India, where the movement of rakes gets highly impacted. So the solution to this is that pre-monsoon or pre-winter, if stocking can be done. This, of course, was the case in many years when the power plants were doing that. However, in last few years, the power generating companies have been under tremendous pressure because the payments that they are supposed to get from the distribution companies have not been coming on time.
Dr. Sinha, there's this one of the points which came up when this crisis was there when it started happening, the coal shortage, was to allow company like yours and Adani, which have put up huge capacity based on imported coal, and they be allowed to sell in the open market, in the spot market. So do you think it is time to transition to a dynamic electricity market where these kind of issues do not crop up?
Exchange works on demand supply. So if there's more demand and less supply, then it is obvious that the rates will go up. And to take care of this requirement, the Ministry of Power had suggested that till such time this situation improves and to bring more power in the exchange, let these imported coal-based plants be allowed to operate and supply it through the exchange, and let everyone buy it from the exchange so that there is enough availability of power in the exchange which can be bought by either the procurers, existing procurers, or even other procurers, and thereby bring down the overall cost of electricity through the exchange. So I think this was more of an interim solution that was being found. But now going forward, this can be a permanent solution also, that whenever there are certain aberrations in the market, especially if the prices become unviable, and the generators are not able to supply to the procurers, they be given the flexibility to supply through the exchange so that the balancing requirement of power can be done and it does not lead to unnecessary hike in the cost of power through the exchanges.
Thank you, Dr. Sinha, for talking to Business Standard.
Our benchmark indices scaled fresh lifetime highs last Friday, defying a weak global mood. But in recent weeks, global analysts have scaled back their bullish bets in view of a likely spillover of the potential default at China's Evergrande. And there also are the imminent taper by the US Fed and a rise in infections due to the Delta variant of coronavirus. So, does that mean a market correction is on the cards? And should you really be worried? Let's find out.
The 30-pack BSE Sensex claimed the historic 60,000 mark last Friday and marched ahead to hit a record high level of 60,333. Its NSE counterpart, the Nifty 50, also touched a new all-time high of 17,948. The BSE Sensex has climbed its last 10,000 points in just 246 days and 5,000 of that in just 42 days. Going forward, while expensive valuations, a cautious global mood amid the Evergrande crisis, and a possibility of a third COVID wave may trigger mild profit booking in days ahead, most analysts remain optimistic. They suggest that a market correction, if any, should be bought into from a medium to long-term perspective. On tech charts, the Sensex looks all set to add another 1,000 points in the next 5 seasons.
The last week, BSE Sensex touched 60,000 mark, a sentimental breakthrough that will see higher levels in the current week. Technically, we expect Sensex to touch 61,000. It could even see 61,250 levels with a support of 59,500. For Nifty 50, we expect it to scale towards 18,000, 18,100 levels and continue to trade in the overbought category of various technical indicators, having a support of 17,750. For both the indices, Sensex and Nifty, we expect them to trade with a strong, firm bullish bias, and technically, market participants are expected to take keen interest in this upcoming rally.
Motilal Oswal, Financial Services MD and CEO, Motilal Oswal said, "The rally in domestic market is driven by positive global cues, strong inflows by FIIs and DIIs, good corporate earnings, falling COVID-19 cases, upbeat corporate commentaries, and low cost of capital. Amid the buoyant sentiment and the increased activity, market valuation has reached elevated levels and demands consistent delivery on earnings expectations. Given rich valuations, one cannot ignore intermittent volatility." Fundamentally, the first half of this week will be guided by global cues where investors will track developments around Evergrande Group, and the second half is expected to be driven by domestic triggers. Let us go to Religare Broking's Ajit Mishra to know more.
So it was a roller coaster ride for the equity markets in the passing week as the benchmark swung on both sides and finally settled with a gain of over 1.5%. And importantly, Sensex tested a new milestone of 60,000 and Nifty also inched closer to the 18,000 mark. So the ease in the China's Evergrande crisis and no negative surprises from the US Fed largely boosted the sentiments. And in the coming week will mark the beginning of the new month also, and participants will be eyeing the monthly auto sales data and Nikkei manufacturing PMI data during the week. And talking about the markets, we expect the prevailing buoyancy to continue, and we expect Nifty to test 18,100 mark next week. However, since we have already seen a sharp surge across the board, we recommend maintaining extra caution in the stock selection and continuing with buy on dips approach.
If your employer shut shop and did not issue you Form 16, does it mean that you do not have to pay tax or file a return? What should you do if your employer deducts TDS but does not issue a certificate? In this section, we will explain all that there is to know about one of the most important documents. Yes, you're right, we're talking about Form 16. We are all familiar with the wait for a document called Form 16 in order to file income tax returns. Ever wondered what Form 16 really is and what it tells about the taxpayer? Today we will talk about the significance of one of the most important documents for taxpayers in India. First, let's understand what is Form 16. Basically, it provides details about the salary you have earned during a financial year and the amount of tax that has been deducted by your employer and deposited with the IT department. Is it mandatory for employers to issue Form 16? Yes, it is mandatory if any tax has been deducted at source from an employee's salary. What if an employee has changed jobs in the same financial year? If you have changed jobs or worked for more than one employer at the same time during a year, and the tax has been deducted by more than one employer, you will be issued separate Form 16s by the employers. Now you must have noticed that every Form 16 has two components, Part A and Part B. What do these parts contain? Part A of Form 16 provides details of the tax deposited in the government's treasury every quarter. It also has details of your permanent account number, your employer's tax deduction account number, and other such information. Your employer can generate and download Part A of Form 16 through the Traces portal. On the other hand, Part B of Form 16 has a detailed breakup of tax computation, gross salary paid or credited, exemption or deduction claimed, and any other income declared by you as an annexure to Part A of Form 16. In short, it's safe to say it is the detailed computation of tax on income of salaried employees. Now let's not confuse Form 16 with Form 16A. They are not the same. Form 16A is also a TDS certificate. But while Form 16 is only for salary income, Form 16A is applicable for tax deducted at source on income other than salary. For example, Form 16A will be issued to you for tax deducted by a bank on the interest you have earned on fixed deposits, insurance commission, rent receipts, etc. All details in Form 16A are also available on Form 26AS. So what happens if no tax has been deducted at source? Does the employer still have to issue Form 16? If no tax has been deducted, the employer need not issue Form 16. However, you can still request your employer to issue Part B of Form 16 in order to file your tax returns. What should you do if your employer deducts TDS but does not issue a certificate? Well, in that event, your employer will be liable to pay a fine of 100 rupees per day under Section 272A 2G of the IT Act till it issues the certificate to you. Now, if your employer shut shop and did not issue you Form 16, does it mean that you do not have to pay tax or file a return? No. According to Section 139(1), if your total income in a particular tax period exceeds the basic exemption limit of 2.5 lakh rupees, you have to file the return of income, irrespective of whether Form 16 was issued or not. Finally, here we have a few important points to remember as taxpayer. You need to ensure that all the information declared in Form 16 is true and correct. If any information is found to be incorrect, you should immediately get in touch with your employer and get the error rectified. In case Form 16 has not been issued to you, you can request your employer to issue it. You can also check whether or not your employer has deposited your TDS with the government by logging into your account on the income tax portal and downloading Form 26AS. And the most important of all, even if your employer has not deposited the tax deducted from your salary into the account of the central government on your behalf, the burden of paying the tax is on you, not your employer. That's all we have for you today. We will be back tomorrow with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.